Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. It's Wednesday, folks, December 28th, 2022. Halfway mark, so let's get to it. And we've got fresh FTX news tonight. And that news comes with a warning, because we've got scammers who are pretending to be government officials. They're trying to steal money from crypto investors who lost funds in the FTX collapse. The Oregon Division of Financial Regulation has warned that fake applications and websites created by scammers may try to take investors' money without giving anything in return. They advise investors to research and carefully consider any crypto trading platform before sending funds. The state regulator gave an example of a website that claimed to be affiliated with the U.S. Department of State. This website said that it was trying to help FTX customers get their assets back. However, the website was actually a scam. And this scam proved fruitful because they were able to obtain information such as usernames and passwords from an investor. TK Keene is the administrator of Oregon's Division of Financial Regulation. He emphasized the importance of being cautious and doing thorough research before investing. He also urged people to protect their sensitive information, such as usernames and passwords. Keene reminded people the saying, "If it sounds too good to be true, it probably is." He noted that there are many deceptive practices within the crypto industry that aim to take advantage of people. He encouraged victims of crypto-related scams to file complaints with the office. Scammers are everywhere. Be vigilant. And our FTX coverage continues because FTX customers filed a class action lawsuit to get priority reparations. Customer class members don't want to stand in line along with the creditors of a failed crypto platform. Now, at present, several government agencies are suing FTX and its founder, Sam Bankman-Fried. A group of former customers, represented by 4 individuals, have filed a class action lawsuit demanding that they be given priority access to the frozen funds of the company over investors. The goal is for the customers to get their money back first. And so it came to pass that a class action lawsuit was filed on December 27th in the United States Bankruptcy Court for the District of Delaware. This was by 4 plaintiffs who claimed to be representing a class of former FTX customers, potentially numbering up to 1 million individuals. The lawsuit aims to obtain priority rights to return digital assets held by FTX US or FTX.com to its customers. The lawsuit accuses former executives of FTX of intentionally using customers' funds to fund risky strategies and a luxurious lifestyle in the Bahamas, which it says was in direct violation of FTX's own customer agreements and terms of service. The filing said, quote, FTX executive defendants failed to institute any corporate controls and were therefore able to cause, direct, or allow the misappropriation of billions of dollars in customer funds and digital assets deposited or held worldwide at FTX. The plaintiffs in the lawsuit state that the FTX user agreement did not allow the platform to use customer funds for its own purposes, such as borrowing or covering operating expenses. They claim that any removal of customer funds from accounts was an illegal use of their property, referred to in the complaint as impermissible commingling, misappropriation, misuse, or conversion. The lawsuit argues that any frozen funds found to be customer property should not be used to pay non-customer expenses, claims, or creditors until customers are repaid. It states that customers should not have to stand in line with other secured or unsecured creditors in bankruptcy proceedings to share the remaining assets of FTX Group and Alameda. And as we were just talking about last night, the Department of Justice has recently started an investigation into the disappearance of around $372 million in digital assets from FTX. On November 12th, FTX alerted its customers to unusual activity in their wallets, involving the transfer of at least 228,000 Ethereum out of the exchange by an unknown party as the platform was going through bankruptcy and internal problems. And on the subject of Sam Bankman-Fried, after he was bailed out, Alameda wallets were used again. This is raising suspicion about the timing among the community. So what happened is, wallets belonging to Alameda Research transferred out funds shortly after Sam was released on his $250 million bond, which didn't really cost $250 million, but whatever. Now that's particularly egregious given that Alameda Research itself is bankrupt. The movement of funds from the Alameda wallets caught the attention of the community, particularly in the way that the funds were transferred. The Alameda wallet was observed exchanging small amounts of ERC20s for Ethereum and Tether, and then those tokens were transferred through instant exchangers and mixers. A wallet with the address of 0x64E9 received more than 600 ETH from the Alameda wallets. Some of this Ethereum was exchanged for Tether, while the rest was sent to ChangeNow. On-chain analyst ZachXBT reported that Alameda Wallet eventually exchanged the funds for Bitcoin on decentralized exchanges like FixedFloat and ChangeNow. These platforms are frequently used by hackers and exploiters to obscure the origin of their transactions. The FTX situation has had many developments, and the recent movement of funds from the crypto wallets has caused concern among the community. There was great speculation about the way the funds were exchanged, how it resembled the actions of an exploiter. But given Bankman-Fried's criminal history, it also suggested that it could be an insider attempting to take the remaining funds from the wallets. Some people questioned the bail conditions and why Sam Bankman-Fried was allowed access to the internet at all. One person wrote that the former CEO was, quote, trying to move money out desperately, and asked why the bail conditions did not include a ban on computer and internet access. These hacks seem to correspond to the movements of Sam Bankman-Fried. This current attack on Alameda wallets occurred at the same time of his bail. This seems to be part of a pattern, because remember, FTX wallets were hacked for a large amount of money shortly after that exchange filed for bankruptcy on November 11th. And speaking of exchanges, 7 executives from the South Korean cryptocurrency exchange V Global have been sentenced to prison for fraud. The CEO of the company had previously received a 22-year prison sentence. Out of the 7, 6 executives from V Global have been sentenced to prison for their involvement in a fraud case worth $1.5 billion. The sentences range from 4 to 8 years in prison. 3 of the executives were not detained and will be allowed to contest certain charges in court. V Global was a cryptocurrency exchange that operated from July 2020 to April 2021. It attracted around 50,000 investors by promising high returns and offering payments for referring new customers. The company promised returns of 300%, which anyone who's listened to this show with any regularity knows is a huge red flag. Now, 2 high-ranking officials from V Global named Mr. Yang and Mr. O have been sentenced to prison for their role in defrauding investors. Mr. Yang received a sentence of 8 years, while Mr. O received a sentence of 3 years. This information was reported by South Korean media outlets on December 26th. 4 other executives from V Global, whose names were not provided, received prison sentences of 3 years and 5 years of probation. 3 of the 6 executives have not been detained as they claimed innocence on certain charges and have the right to defend themselves in court. The judge from the 12th Criminal Division of the Suwon District Court said that the defendants in the V Global case only trusted the management team and evaded responsibility. They also destroyed evidence and interfered with the investigation when it began. According to reports, the judge gave the defendants some leniency because the actual amount of fraud and the number of affected investors was lower than initially estimated. In February, Kyung-yen reported that around 10,000 investors had made returns from V Global through payments from multi-level marketing incentives, such as customer recruitment bonuses. Many of these investors reportedly reinvested their profits back into the platform before it was shut down. This information may have been a factor in the leniency shown by the judge in the case. It was reported in June that V Global paid customer referral bonuses worth $1,000 each to existing investors with capital from new users, which had a Ponzi-like structure. All of which means 7 executives from V Global are now in prison as a result of the latest court action. The CEO of the company, Mr. Lee, was sentenced to a 22-year prison term in February. And last night, we were talking about Argo blockchain. They halted trading in advance of an announcement. Well, we have an update for you. Argo blockchain has sold its top mining facility. That facility, Helios, was sold to Galaxy Digital for $65 million. As part of the deal, Argo blockchain has also received a $35 million loan from Galaxy. This has allowed Argo blockchain to reduce its total debt by $41 million. And we know that Argo blockchain sold Helios in order to weather the current bear market. The CEO, Peter Wall, announced the deal on December 28th. As part of the agreement, Argo blockchain has been selling the Bitcoin it's mined in order to pay back the loan from Galaxy. In addition to buying the Helios facility, Galaxy will also provide Argo with a $35 million equipment finance loan. This loan will be used to help Argo reduce its debt. The proceeds from the sale of the Helios facility will be used to pay off debt owed towards NYDIG and other secured lenders. Wall stated that the new transactions, which include the sale of the Helios facility and the $35 million loan from Galaxy, are intended to reduce their total debt by $41 million and improve its liquidity and operating structure. These actions will allow the company to continue its mining operations. The CEO said that the sale of the Helios facility and the loan from Galaxy Digital were the only viable path forward for the company during the bear market. This is due to high energy costs and low Bitcoin price. Wall also noted that Argo has not sold any of its mining machines and signed an agreement to continue using them at the Helios facility. Wall said remaining at the Helios facility will allow the company to continue using power from the Texas grid and participate in the ancillary services offered by ERCOT. The sale of its Helios mining facility to Galaxy Digital is happening just 6 months after it was officially launched in May of 2022. The Helios facility, which is located in Dickens County, is the largest of Argo's mining facilities. It has the capacity to support 200 megawatts of electricity. By comparison, another Argo facility has the capacity of only 15 megawatts. Argo blockchain has recently struggled to secure financing. They've been at risk of closing due to a lack of new funding. In October, the company announced that it was in danger of closing. In mid-December, Argo announced that it was negotiating to sell its assets and seeking to, quote, engage in an equipment financing transaction in order to avoid bankruptcy. This news comes after the company failed to raise $27 million through the sale of ordinary shares. Sticking with exchanges, the Winklevoss twins are in some hot water. In fact, some people who invested in cryptocurrency are suing them over interest accounts on Gemini. The plaintiffs claim that the products have not been registered, and this has prevented them from getting information about the risks of using Gemini Earn. Tyler and Cameron Winklevoss are being sued by investors over the interest-earning program called Gemini Earn. The investors claim that the company has committed fraud and violated securities laws. Now, this comes to us from Bloomberg. A complaint was filed in a Manhattan court on December 27th. It states that the Winklevoss brothers stopped allowing investors to receive their money back and refused to allow any more investor redemptions. This happened after the brothers halted redemptions due to the company's exposure to a troubled trading firm called Genesis Global Capital. The plaintiffs in the case claim that the products offered by Gemini Earn have not been registered. This kept them from getting information that would help them understand the risks of using the platform. Gemini Earn was launched last year and was meant to help people earn up to 8% interest on their cryptocurrency holdings. Gemini Earn had some problems starting in mid-November, around the same time that reports emerged about liquidity issues at FTX. Since then, Gemini Earn has not been available for users because there is a large amount of money stuck on Genesis. Some reports say that Genesis and its parent company, Digital Currency Group, owe as much as $900 million to Gemini clients. On December 20th, Cameron Winklevoss used Twitter to announce that Gemini had developed a plan to address the liquidity issues at Genesis and Digital Currency Group. This would allow them to recover assets on behalf of the creditor committee. On December 7th, Genesis sent a letter to its customers stating that the freeze on withdrawals was likely to last a few more weeks while the company worked on a plan to recover users' assets. Genesis stopped allowing withdrawals on November 16th, citing unprecedented market turmoil caused by problems at FTX. Yuga Labs is suing an artist and his business partner for creating fake copies of their Bored Ape Yacht Club NFT collection. The artist and his partner have filed a counterclaim in response. So what's going on is, last June, Yuga Labs sued writer Rips. They also sued Jeremy Cahan, founder of the NFT marketplace Not Larva Labs. Both suits were for copying Yuga Labs' NFT collections, thereby damaging the value of the original Bored Ape products. Rip and Cahan have denied many of the accusations in response to the lawsuit. The court filing from December 27 states that each NFT is a unique entry on a decentralized digital ledger and cannot be copied due to its non-fungible design. Rips and Cahan argue that their version of the Bored Ape Yacht Club collection does not violate the copyright of Yuga Labs. They also claim that they use their art to criticize the hateful imagery they claim is used by Yuga Labs. A spokesperson for Yuga Labs said that their lawsuit holds Rips and Cahan responsible for stealing Yuga Labs trademarks. The spokesperson said the pair deceived consumers and made a lot of money by using Yuga Labs' intellectual property to sell fake NFTs. The spokesperson also said that they will continue to prove their case as the lawsuit continues. Now, this lawsuit is unrelated to a class action lawsuit brought by California firm Scott & Scott. In that case, the company is accusing Yuga Labs and around 40 other people and companies of being a part of a plan to secretly promote products like Bored Ape Yacht Club with the help of celebrity endorsements. A Yuga Labs spokesperson denied these allegations. Another company facing issues during the crypto winter is Midas. Midas Investments is an investment firm that invested in DeFi yields. The company is shutting down its platform due to significant losses in 2022, according to its CEO, Trevor Levin. The company's DeFi portfolio lost $50 million, or 20% of its $250 million in assets. After Celsius and FTX collapsed, over 60% of the company's assets were withdrawn from its platform. Levin wrote that due to the current market conditions and the company's situation, they have decided to close the platform. Midas Investments plans to focus on a new project related to centralized, decentralized finance. On Tuesday, Midas Investments disabled deposits, swaps, and withdrawals. The company plans to deduct 55% from user balances held in Bitcoin, Ethereum, and stablecoins, and then compensate those users with Midas tokens that can be swapped for tokens in the company's new project. The adjustments are being made while the company performs calculations and balance adjustments. According to Levin, the goal of the company's new project is to create a mutually beneficial situation by connecting competing protocols with liquidity and offering a simplified yield to a range of DeFi and CeFi audiences. And that's going to do it for us tonight. I want to thank you, my listener, because when you stop listening, I will stop talking. We'll see you tomorrow night.